All right, we're going to go ahead and get started. So today's topic that we're talking about is going to be credit cards. So our priority today is a couple of different topics. And I want to say that during the presentation, if you have any questions, please feel free to go ahead and use the chat. You can also unmute yourself, and then we'll go ahead and answer your questions along the way. We will also give the availability at the end of the presentation for a Q&A as well. With that, we will go ahead and get started. All right. So before we get into today's content, I want to go ahead and introduce myself. My name is Ivory Becker. I am the owner and founder of Insight Strategies Credit Repair. So we help our clients with establishing credit or restoring damaged credit. And we work primarily with loan officers and clients who have been unable to secure a mortgage. And due to that, I'll ask you to go ahead and just mute yourself unless you have a question here. And so by the end of 2021, we were able to successfully remove almost 8,000 items from our client's credit report. And one of our primary focuses here at Insight Strategies is also education when it comes to credit, how credit scoring works, debt, really anything around the financial services industry. So today, our main area of focus is learning the dirty tricks used against you by the credit card companies, and then learning how to utilize credit cards to positively impact your credit score. So 459 million credit cards are currently in circulation just in the United States. Pretty astounding statistic. And consumer knowledge about credit is on a significant decline. So according to a survey from the Consumer Federation of America, only about 66% of participants knew that keeping a low credit card balance helps to raise a low credit score or maintain a high one. Well, 85% knew this in 2012. So you can see that over time, our understanding just from this basic statistic is declining pretty rapidly. And credit cards are so easy to obtain. Has this made us less inclined to research their terms or how they work? Or do we just tend to use them or take them out of desperation when we're in times of need because they're so easy to access? They are, after all, the easiest type of credit for us to obtain with little proof required to access our credit cards or to get approved for that application for credit cards. And they help us get out of binds when we don't have savings. And that tends to be where we see a lot of credit card utilization issues occur. So we're going to start by jumping into the myths. So do you get sick of all the mixed messages about credit cards? What we're going to do is start by sorting through what you need to know. So myth number 1, having no credit cards helps my credit score, and having multiple credit cards is bad for my credit. In reality, someone with no credit cards is viewed as a higher risk than someone who has managed their credit cards responsibly over time. So a lack of credit card history or a lack of history on the credit report can cause someone to be declined from a mortgage or from an auto loan or other types of credit, even if they have sufficient income. Credit scoring is one of those main components to getting approved. And as the Ms. had mentioned as well, having multiple credit cards is not bad for your credit. It's all about how those credit cards are used and if they're being managed responsibly over time. Now, canceling credit cards can cause credit damage. Canceling credit cards can impact your credit score in multiple categories. So for instance, when you close a credit card, you're adjusting the average age of the accounts on your credit report, which is a part of determining your credit score. So all of a sudden, if you close a card and you had that credit card open for, let's say, 10 years or more, or quite a while, it doesn't necessarily have to be 10 years. Once you close that card, you're adjusting the average age of the accounts on your credit report to be shorter, which can then have a negative impact on your credit score. So you are rewarded for having long-standing credit history. Now, it can make sense, of course, to close a credit card. For instance, if the card has an expensive annual fee, for example, I would say if you do need to close a credit card, you don't like it, you don't want it for whatever your reason may be, it would be helpful to replace that credit limit that you're using with either a credit limit increase or a different credit card. And we definitely don't want to close a card if it's going to put you in a position of having no open credit at all. That can be significantly damaging to your report. And towards the end of the presentation, we will go ahead and look at that in a bit more detail and view that actual credit score algorithm. So only about 26% of people, on average, the average consumer knows that closing an account could be a problem for their credit. So it's not a common piece of knowledge anymore. So it is important, if you are someone who's planning on purchasing a home in the near future, I wouldn't make any drastic changes in closing a credit card because that could adversely impact you, especially when it comes to that credit score and the potential change. And again, for those of you who joined us recently, feel free to ask questions throughout the presentation. You can do so using the chat option, or feel free to unmute yourself as well. Myth number 2, carrying a balance will improve your credit score. Let's talk about that. So here at Insight Strategies, we work with people who, of course, have the goal of improving their credit. Oftentimes, we hear in our initial conversation that our clients are avoiding paying their balance to zero because they've heard that keeping a little bit of a balance on their credit card will help them with their credit score. So according to a survey from creditcards.com, 50% of cardholders have carried a balance on their accounts before, and more than 20% believe that carrying that balance will improve their credit score. So if you're carrying a balance in full, a few days before the statement date, there's a high chance to bring your balance to zero before it's reported to the bureau. So I want to explain what that means. Have you ever looked at your credit report and you have seen that your credit score has dropped? And if you look at your credit card balance, you see that there's a balance showing on your credit report, but you know you paid that account off, and you pay your account off every single month. If, let's say you're someone that always makes sure they use their cards and pay them off every month. That's how you pay all your bills, your day-to-day expenses. If you are not making payments, if you're not timing that payment just right, it can be reported to the credit bureaus as a balance on your account, even though you do pay it off every single month. And this is because your creditor only sends this information to the bureaus once a month. Typically, it's sent a couple days for that statement date. So if you're making sure you're timing it properly with that statement date, then you'll never see that fluctuation or that volatility in your credit score, because your balance is always going to show zero, or always going to show a lower utilization. You can alleviate this concern by never using more than 25% of your credit limit. If you're somebody that has a lower credit limit, or the credit limit just isn't high enough for you to not use that 25%, then you may try timing it. But it's still a great idea to see if you can get credit limit increases so you don't have to deal with that volatility in your credit score. And if you are concerned with that volatility and you are planning on financing something in the near future, it's best just to not use that card for a couple of months leading up into that financing. There's a very common misconception that if you don't carry that balance, then positive information won't report to the credit bureaus. In actuality, one of the reasons a credit card can be so helpful to your credit score is because whether you have a balance or not, it reports as positive as on-time payments to the credit bureaus on a monthly basis. So you can have a zero balance on your credit card and still be rewarded each month with an on-time payment on your credit report. Where I think some of this confusion comes from is if you don't use your account for a very long time, let's say 6 months, tends to be on average or more, the data feed between your creditor and the bureau could become stale. It could mean that you're not seeing updated information reported on your credit report, and that's when you may not be reported. So it's safe to say, using your card once every 3 to 6 months would be sufficient in making sure you're being rewarded, but at the same time, not creating more debt for yourself by using your card too much, let's say on accident, or spending more than you meant to spend or realized. All right, on to the next myth. Having a high credit limit means you spend too much and damages your credit score. So having a high credit limit actually helps your credit utilization ratio, especially like what we were discussing previously. If you're someone who uses your credit cards on a month-to-month basis, it makes it so you don't have to worry about the statement dates as well, as I previously mentioned, but it also shows that your creditors look at you as a credit-worthy consumer, right? They see you as a low risk to not being able to manage your debt effectively. And your credit score isn't linked to how much you're spending. So your credit score is 100% ratio based. So you could be somebody that has a $200 credit limit, or somebody else that has a $2,000 credit limit, or even $20,000 credit limit. And it's all about that percentage of utilization. If all three of those people have 100% utilization, they're all looked at in the exact same negative manner. It's going to impact their credit scores, in theory, exactly the same. There are other factors that'll influence each person individually, but based on that utilization, it's all ratio. It's not the dollar amount that matters. So your credit score is meant to help you save money. So if you're someone that is carrying credit card balances, you're really negating the whole point of having a strong credit score, because now you're paying high interest unnecessarily with credit cards. Instead, you can use other types of debt, right? You're getting rewarded when you have a high credit score by getting a lower interest rate on a mortgage, for example. So you definitely do not need to carry a balance and pay unnecessary interest to the credit card companies with the goal of thinking that's going to help you get a better credit score. You do not need to keep a balance. So our next myth is credit card terms are non-negotiable. This one usually surprises most people. So banks want to keep you as a customer, and they're occasionally going to make concessions to do so. So let's say you've been offered another credit card and has better terms. You may be able to use that with your current creditor to negotiate whether, let's say, you're trying to get a reduced annual fee or not have an annual fee for a year, or perhaps request a reduction on the interest rate on your credit card. Most people don't realize you can request to have a credit card interest rate reduced. I have definitely made practice of negotiating my interest rate and have been able to get a credit card with an interest rate at 7%, which is extremely low and not really heard of nowadays. Most interest rates on credit cards are double digit. So I encourage you to contact the credit card companies. If you do want to be in a position where you don't have a balance, you have to have that leverage, right? If you think of it from the credit card company's perspective, their goal is, how do I get this consumer to use this credit card so I can charge them interest? If they're not using the card much, maybe if I lower the interest rate, then they'll be willing to use the card, right? So they may make that concession to lower the interest rate, hoping that that will make you use the credit card. carry a balance, and then they're going to get rewarded by being able to charge you interest. So you don't have to use the card, right? But if you do need to, at least now you have it available at a lower interest rate. So, and there's other terms, of course, that you can negotiate as well, but the primary one that tends to come up for most people's concerns are annual fees and interest rates. So those are some of the common myths. I'm going to transition into some of the dirty secrets of the credit card industry, and then we're going to finish up with looking at the actual credit score algorithm. So the Credit Card Act of 2009 helped to create more protections for us as consumers from some of the unfair and abusive practices by the credit card companies. The act required notices for things like interest rate increases. It removed double cycle billing and created limitations for late fees, over limit fees, and then it did place caps on some of the other fees that credit card companies would assess. The protections don't extend to business credit cards. So keep that in mind. If you are somebody that has a business credit card, everything that we're about to talk about, that we're about to discuss, is not covered for your business credit card. This is very specific just to consumer credit cards. So even though we've seen all of these changes based on the Credit Card Act of 2009, these companies still don't have the consumer's best interests at heart. And that's really what we're going to look at, is how even with these changes, credit card companies are taking advantage of you. Because I want you to know how they're doing that, and then have you know exactly what you can do about it at the same time. And I'll explain what double billing is really quickly, since I hadn't mentioned that. So double billing is essentially, in the past, what they would do, what some credit card issuers would do, is use the average daily balance of your last 2 billing cycles to calculate interest. So they pretty much take the highest balance and calculate your interest off that highest average balance, instead of taking the true interest they should be assessing. So people were paying more in interest than they should have done. All right. We'll move on here. Okay, so APR issues and late payment penalties. So even with that Credit Card Act of 2009, there is no maximum interest rate cap on credit cards. No maximum cap at all. So what that means is, when it comes to other fees that they did place caps on, like the annual fee cap, and some of the other fees they're not allowed to charge anymore, what they've done is they've essentially moved over those fees to charging higher interest rates, so they can still make the same amount of money. So the Credit Card Act restricted the amount of annual fees to 25% of the credit limit on the account. So no credit card can charge more than 25%, which is already astronomical. And then in response, I'll give you an example of what happened, just to kind of bring this all to light. First Premier Bank, after that law passed, changed their interest rate to 79.9%. And now it may not be at that point anymore, but back in 2009, when this change occurred, because they were charging so much in annual fees, the only way they could adjust and make the same level of profit was by raising their interest rates to 79.9. Pretty astronomical. So it's also best to keep in mind, if your interest rate is tied to an index, more commonly the prime rate, when that index adjusts, your interest rate will as well. So if the prime rate goes up, then your interest rate is going to go up on your credit card too. So it could constantly be moving. And if you're not tied to prime rate, your credit card company, they can raise your interest rate at any point in time. Now with the act from 2009, they do have to give you a 45-day notice. So previously they didn't have to give you any notice, but now they just have to give you a 45-day notice. Most people don't even realize when they're getting the notices, because we get a lot of mail. Maybe you're not. Maybe you're doing like e-billing, non-paper billing, if you will. You don't check the emails. But essentially all they do is give you 45-day notice, and then your rate's up, and they can raise it as much as they want. So let's talk about late payments as well and how that impacts the interest rates. So if you're more than 60 days past due on your monthly payment, your interest rate can be increased. It's known as penalty APR. So after 6 months of that rate increase, of that penalty APR, if you've made payments consecutively on time during 6 months, then the credit card company is supposed to change your rate back to where it was prior to that penalty APR. However, you may have to request the credit card company to actually do this. So a lot of times the companies won't proactively do it. So you yourself need to take that on and make sure you're requesting that they put your rate back. It's a rule that doesn't benefit the company, so just don't be surprised when they don't contact you at all. You end up having to take a lot of the task on yourself as a consumer, because remember, the entire goal of the credit card companies is to make as much money as possible. That's it. Okay, moving on. So promotional offers and rewards. We all get suckered into promotional offers. I know I do. It's hard to not want to sign up for a new credit card if you find out you're going to get all of these miles on an airline or all of these rewards, especially when they offer the money back rewards, right? So these promotional offers, a lot of times we see offers for a 0% interest. But often people aren't paying attention to what that interest rate is going to switch to after the 0%. And most people don't actually pay off at the end of that time period. And the credit card companies are counting on this. And we'll, in the next slide here, we're going to look at how minimum payments have changed over time as well. And the credit card companies are, of course, counting on you not being able to pay it off, because it puts more money in their pockets, right? They're going to be able to assess you interest. Some of the terms are during that promotional period, if you do not fully pay off that balance, then now all of the interest that would have been assessed during that period can now be due. Not every promotion is like that, but it's really important to pay attention to the terms, because now all of a sudden they may tack a whole bunch of interest on there, increasing your balance, and now you're going to get more interest on top of that interest, and it's never-ending cycle. So just pay attention to those promotional terms. Really look at them. The big letters or the big pieces that they're highlighting are not what you want to pay attention to. It's the fine print. And then, as I mentioned down here, if you've got a card that gives you 1 point per dollar you spend, you're really just getting back a penny on every single dollar. It's a penny you didn't have before, but you're still paying annual fees or maybe other fees on your card. So when you're looking at those rewards, really think about it, really do the math on if you're actually really getting rewarded, or you're just breaking even, or maybe not even getting rewarded at all. Minimum payments. So as I had mentioned, minimum payments have been changing. So they've been lowered in recent years, and this is definitely by design. So it used to be where you had to pay a 5% minimum payment on all of your credit cards. It became more problematic for the credit card companies because people were paying their balances off too quickly. So they lowered that monthly minimum payment to 2%. And some even have lowered it further to 1%. So by decreasing that minimum payment, it of course encourages you to stay in debt even longer. And if you look at this example that I have up here on this slide, a $5,000 balance with the interest rate just under 19%, with that 2% minimum payment, you're spending about 30 years paying just that $5,000 off. And then at the very end, you're paying almost $20,000, all just for $5,000 of your original principal balance. So you're, again, less likely, let's say you got this credit card from a promotional offer, 0% interest for a year. They're only charging you 1 to 2% of your balance. You didn't pay it off during that time, and now it's just extended out. And this is how people end up getting into massive amounts of credit card debt, right? They didn't pay it off during one promotional balance, so now they apply for a new credit card and do the same thing. And that's when all of a sudden you end up with multiple credit cards, and multiple payments to make, and you can't make more than the minimum payment on any of them, your credit has now been impacted because now your utilization is high on all of your accounts and you just feel stuck. This next sneaky thing that these credit card companies do, I think will surprise most people. So most people tend to think that when you make a purchase on the credit card, you have a grace period where the interest doesn't accrue, right? If I pay it off within the same month, then I'm not going to pay any interest on that. No penalty to me at all. Depending on the credit card, you may or may not have a grace period. Some credit cards now have eliminated the grace period altogether, meaning from the time that you make a purchase, interest is already accrued. It's automatically starting to accrue on a daily basis. Some cards still have a grace period that's 20 to 25 days, but that's not that full 30-day time frame. So it's really important to make sure you look at the terms of your credit cards and make sure you understand, does it have a grace period or not? Am I actually paying interest every month and I'm not even realizing it? Maybe you have it on auto pay to pay the full balance every time and you never really looked. It's something to consider. So again, those terms are very important. One of the other types of, I guess I would say, newer trends that I've been seeing quite a bit is the no limit credit cards. There are a couple of companies that offer these no limit cards. American Express is a common example. So they're often advertised as no credit limit, but really they have a preset limit. So many consumers find out the hard way that they do have a spending cap. So the true limit is based on your own month-to-monthly spending behavior and sometimes your income as well. So for example, let's say you have a cap of 5,000. You might not know it, but you have a cap of 5,000, and you only learn that you have a $5,000 spending cap because you spent $7,000 on your card, and then you receive a bill that says you have to pay $2,000 plus the accrued interest as your minimum payment in your next billing period. And all of a sudden you're like, well, I was not planning on paying $2,000. I was going to put this on the card and pay it off in a couple months because I had an unexpected expense come up and I just didn't have the ability. Now all of a sudden you have this giant bill and you didn't even realize that you were going to have to pay $2,000 plus the interest. You thought it was just going to be your normal monthly payment of 2% or whatever it is. So your credit card company may have advertised no limit, but it's really, what it really means is no preset limit. So, I mean, keep in mind, no company is going to write a blank check, whether it's attached to a credit card or not, right? They have to mitigate their own risk as a company, and they just may not be advertising things in a way that, in my mind, you know, it's pretty unethical to do things this way. But okay. So looking at everything we just went over, it's not surprising that many people have fear around the credit card industry and credit cards in general. And if you've been burned by credit cards, you're not alone. So 15% of Americans have been in credit card debt for 15 years or greater. That's a very long time. And 45% of Americans have taken on more credit card debt during the pandemic. So since March 2020, almost half, right? That 45% of Americans had taken on one or more new credit card debts. And individuals who carry a credit card balance from month to month are more than twice as likely to report having more debt now than before the pandemic, which isn't surprising. So you just learned what is myth and now what is fact about credit cards and some of those sneaky tricks that the credit card companies use. So now that you're armed with this information, you can move forward, because unfortunately, if you want a strong credit score, it is required to open up credit cards on your credit report. And we're going to talk about that next. So my goal today is to remove some of the fear and confusion and empower you with the information you need to make more educated decisions on how to choose a credit card and know what they're going to try to do to use them against you so they can make more money and put you in a position of power with the credit card companies, right? Now you know you can negotiate. Now you know what to look for in the terms of credit cards. as far as those sneaky things. And when it comes to your past, even if you have experienced high amounts of credit card debts, or even charged off credit cards or credit card collections, or you've just been afraid to use credit cards in the past, it is something that you will want to do if you want to get to that point of having that perfect credit score. So what if you did have late payments on a credit card before? So according to a survey, 57% of Americans have missed at least one credit card payment. So it's not unusual, right? More than half of us in the US have missed one late payment. Most common reason was for forgetting, but the next most common reason was for food or groceries. And some creditors are willing to work with you on a late payment. So all you need to do is call them. A lot of times they will offer 1 or 2 goodwill removals for hitting your credit report. So give them a call right away. Don't wait a year or two. Just call them right after it happens. And if you can't afford your payments at all, a lot of times they will offer modifications. So you can get your payments reduced. They may close your account in order to provide you with that modification, but it's a better result than having the account go to collections or be charged off eventually. So since we can't afford, since we can't avoid credit cards altogether, if you want a high credit score, how can we use them more effectively? So I want to look at the credit score algorithm and show how having an open credit card with low utilization can impact your score. So the biggest category we'll start with is payment history. So payment history is 35% of your credit score. So it's that biggest overall factor. So when you have an open credit card, or let's say you haven't had any credit cards in the past or they're closed, whatever your situation, when you open a card, now all of a sudden you are able to build strong positive payment history, even if you keep it at a zero balance. So every single month you're reporting an on-time payment to the credit bureaus. If we look at the second biggest factor, which is that credit utilization on the top right side here, that's 30% of your credit score. So just with these two factors alone, we're already impacting 65% of your credit score. So if you're someone who has no credit cards in your credit report, this 30% you're completely missing. It can suppress your credit score to a certain point, right? You won't be able to get beyond a certain point if there's no open and active lines of credit on your credit report. So again, utilization is just your credit limit versus your your balance versus your credit limit. So keep that low. 15% is length of credit history. So installment loans like auto loans, any other types of loan, personal loans, consolidation loans, they all close at a certain point, right? They have an end date. A credit card is open. It doesn't have an end date. So you can positively influence the average age of the accounts on your credit report and make that average age longer by keeping those credit cards open, or that credit card or 1 or 2 cards open for a very long period of time, which is going to positively impact your credit score. And then 10% of your score is the mix, right? For the credit score algorithm, they want to see a blend of installment and they want to see a blend of revolving accounts. If you have no revolving accounts, you're not going to see the biggest impact in this category of that 10%. So just having a credit card, especially if you're in a position where you're trying to rebuild your credit or establish credit, it impacts 90% of the calculation of your credit score. So it's huge. It's huge. So to summarize what you can do, you can use credit cards to help improve your score by keeping a zero balance. If you use your card monthly, pay your balance prior to the statement date so that you don't see volatility in your credit score. You don't see that going up and down and up and down. Request credit limit increases and never spend more than 25% of your credit limit. So you never have to worry about the utilization, right? Then you're not going to see the volatility because you're never spending too much. Don't close aged credit cards, right? You don't want to negatively impact the average age of the accounts on a report. And find credit cards with low fees and negotiate those fees and that interest rate, that APR. Because that's going to allow you, if you do ever get into a bind, to not get in a situation where it's really hard to pay off that debt. And if you are starting with a secured credit card to rebuild your credit, let's say you're coming from a point of poor credit and you're ready to now transition to unsecured cards because you've done some work, your credit score is in the 600s now, make sure you apply for your new unsecured credit card before closing your secured card. So secured cards are meant to be temporary. So you want to replace that open line of credit with something else so you don't see your score drop. You're not going to see a huge impact when you close this card for the average age of your accounts, because in theory, you really should only have that card for 6 months to a year. So it shouldn't skew things heavily, like closing a card that's 7 years old, 10 years old, 5 years old. And if you have a high amount of credit card debt, it can be very helpful to obtain a consolidation loan to improve your credit score. It can minimize fees, minimize interest, of course, and it's also a faster method of paying off your debt. You're on an amortized schedule, right? So you have a set payment by the end of the term that you choose. That account's paid off. You'll be out of the debt. You won't be like the large amount of Americans who are stuck in that credit card debt, for 15, 20 years. You'll be able to pay it off. And ultimately, those consolidation loans, are the rates higher than what we hear about for things like mortgages and auto loans? They are. But in the grand scheme of things, it's a heck of a lot lower than what you'd be paying on the credit card as far as the interest rate, and especially with that longevity, you end up paying that credit card debt off. So that's all I have for the prepared remarks. Does anybody have any questions at all about credit cards or their impact to credit scores, anything in between? There are no questions. We will go ahead and conclude for today. We do host these webinars about once a month on different topics. Some go into quite a bit detail about the credit reporting or collections, really any or debt management. We have all sorts of topics. If there's a specific topic you'd like to see, feel free to reach out. You should have my email contact information here after this webinar. I'll go ahead and send an email recording of our webinar today, so feel free to reply there. Otherwise, stay tuned for some more webinars coming up in the future. Thank you, everyone.